The Fed can put out the fire of inflation, but it's going to take higher interest rates. You came here for the truth, so let me unveil that for you. Today we are going to look at a few topics that I believe you'll find interesting. I wanted to begin by taking a look at the potential for a correction coming in the near future. There are many economists that have suggested this is coming. It's as a result of the expectation of inflation. It doesn't even need to be at a certain level. It's that expectation that is coming. I also want to look at inflation itself. This is so important because people are looking at the statistics of the CPI and all these, but what we should be taking into account is our housing prices, our rent prices, and you look at everything we purchase, the food and so on, and that gives us a much more accurate example of what's really going on. And then I want to talk about real estate because there's so much going on here, and it is very clear to me that the Federal Reserve is pouring gasoline on the fire. Let's begin. Beware of inflation headwinds. It could take a year to break even after 10% to 20% market correction. This is according to economist Mark Zandi. And this individual from Moody's has made predictions before, just like all of these other people, but you've got to take it into the whole perspective and the whole context to understand what's really going on. When you have the expectation of the Federal Reserve changing a policy like interest rates, that affects everything, absolutely everything in the financial system. So let's understand what he means here today. I'm looking at the markets already. This happens to be the Japanese market as I record this video. I'm watching it live and seeing what happened. This is the previous trading session right up here, and it's around, just under 29,000. Their market opens up and it immediately gaps down. And then we look at throughout the trading day, it's going further, lower and lower and lower. Now it has picked up a little bit, but of course the trend has been much lower on the day. In fact, it was down at 1.4% in a single day. So a 10% correction, a few trading days like this, it could definitely move in that direction, of course. Now you're looking at the different indicators that I've got here, and all I wanted to show you is simply the price action. But what we are seeing here could be more of what the same happens in the United States, because I'm looking at the futures today and the futures are showing weakness again. Now that might bring on a short-term scale some technically oversold patterns. You might have day traders coming in buying that dip. But the important point here is that if people believe interest rates are going to rise and there's going to be a taper, that's going to spook them a little bit. That's going to take a little bit of risk off. So what are they going to do? Well, I'll tell you with real investment advice. They shared some information. I'll cover that more in just a second here. Looking at the Federal Reserve specifically right now, because they are going to, as they say here, dominate the market in the next week ahead after the sell-off. So the market had come down, and the market's not used to going down. I mean, seeing the red on the screen is become something of an unusual event. But as they say here, the Fed is set off turbulence in the stocks, bonds, and currency markets the past week when it signaled it was discussing moving toward tapering. And I'd like to go even a step further. It was discussing the potential that at some point they would be discussing a tapering. I mean, that's how far we've come, and the market gets spooked from that. But it's, of course, something that we have to understand could be just a temporary event. And once the market realizes in the next few hours or days or whatever it takes that, look, this is not happening today, let's worry about it tomorrow, then the markets will go higher as a result. This is all important because what's happening right now today? What is the Federal Reserve doing? What actions are they taking? This was interesting. I've shown you the money velocity previously, and you can see this chart goes back even further. The velocity of money from 1900 to 2021. And it is truly unbelievable to see it at the lowest level it has been. We are watching this declining further and further because we've never seen the Federal Reserve do something like this before. There's never been this much money pumped into the system. Look, $120 billion every single month. If they had done that 10 years ago, in the height of the crisis, they would have said, what the heck are you doing? Do you have the legal authority to do this? And so on. And now today they say, please, Please continue printing. May I have some more? Sir, may I have some more? I mean, it's crazy, right? Look at it. Look at the velocity of money. Again, I'm showing you this one from Real Investment Advice. Bank loans and leases versus monetary velocity. And the orange line is the loans and leases, and the black is the velocity of the M2 money stock. Both of them have come down considerably. This isn't something that we should be, if you're trying to be bullish on the markets, if you're trying to be bullish on the economy, this right here, not a good sign. It shows that there is clear and distinct weakness when it comes to the currency or current that's happening here. When you're pumping all this money in and it's just sitting on the reserves of the Fed, you're not going to get the desired effect. That's why they keep talking about bringing in helicopter money and so on. This article here, the housing market is on fire and the Fed keeps adding gasoline, is absolutely 100% true. Look, bidding wars, all cash offers, homes selling for $1 million over the asking price. The housing boom has officially reached the ridiculous stage. It's not just the US. I'll give you some other examples. I think I have it the next article, but this is going on all over the world. All over the world, real estate is soaring. There's a few pockets here and there, but in general, that's what's happening. And of course, you've got interest rates at rock bottom. But as we see, particularly in the developing nations, there have already been 19 rate hikes in 2021 alone. It's definitely much different than what we've seen in previous years, but considering that interest rates have been at rock bottom for a long time, seeing 19 rates in a year is something of significance. Despite surging home prices that are rising the fastest pace on record, the Fed continues to prop up the housing market by purchasing $40 billion of mortgage bonds each month. The Fed just continues to pour more gasoline on the fire. Look, there's a few headlines. Prices are exploding. Of course, making inequality worse. And they do cover one thing, but I just want to make sure running too hot. Yes, that was the one as well. Look at this. Making inequality worse. This is absolutely true. Whenever they print money, whenever they reduce interest rates, they're telling you, and they go on TV, they tell you that this is okay because, we're doing it to help out the people. But actually, statistically, you can see it as documented over and over again. Reducing interest rates, printing money actually makes the situation worse for the bottom 80%. How many people do you know working either, let's say, the average type job or even a higher wage job that have had their salary reduced in this past year and a half? It has happened to so many people. I've heard from numerous people that they have had their salaries reduced. Oh, they're employed. Oh, sure, they're employed. But as you know, for so many people, they have their budget set right up to the maximum. The house, the car, this and that, the private school, and everything that they have set up is right up to the maximum. As long as they keep their job and they keep getting paid what they were getting paid, everything's fine. But suddenly there's a disruption. They're laid off, they got reduced hours, they got their salary kicked to the dirt. Well, you know what? Suddenly you've got a problem. So what do? They go more into debt. You could see people are paying their credit cards off today. Why? Because that's higher interest, but their mortgages for so many people, they didn't have to pay them. They didn't have to pay them back. So they let it ride. So mortgage balances are increasing. At the same time, you've got people that are taking on more debt than ever before. Oh, we got to work from home. So get a bigger house. Get a bigger house, a bigger house. And now the playing field has really been leveled out. This is also connected in with that, the new test for central bankers. Cool. Booming housing prices. Norway's central bank signaled it would raise interest rates to curb a property boom. Other policymakers could be tempted to make a similar, look at the wording they used, Wall Street Journal, mistake. Tempted to make a similar mistake. If that's not propaganda, I don't know what is, because these prices at these levels, increasing at this rate, is a bad thing. Some people might say to themselves, why? My house just went up in price. I pulled the equity out. Now I can go out to Bora Bora. I can pull the equity out. Now I can buy the Beamer. Oh, everything's just fine. But they don't understand. They do not understand the financial system and how it works. You reap what you sow. You reap what you sow. You reap what you sow. Remember that. This is just showing you Norway, Germany, UK, US, looking at the property prices and how they have accelerated. The chart begins in 2006, and you could see, particularly US, how there is a dip downward. But in the example of Norway, these are small dips, and they have really rocketed higher and higher. Of course, they don't include Canada because apparently not even worth going on a chart, even though that accelerated faster than all the rest of them. The world relies on one chip maker in Taiwan, leaving everyone vulnerable. This is something that I think it's a bit nuanced. I want to touch on a couple points here. They're talking about TSMC and their dominance posing a risk to the global economy amid geopolitical tensions and a major chip shortage. You heard it before. I talked about it here on the channel. The chip shortage is a big deal. And I think it's important to look at where the manufacturing is taking place today. Okay? They do get into the fact that, look, these chips coming out of this company, they're in iPhones and computers and cars and every single thing in your house that's running on electronics. Chances are this company has had their hand in it. Now, what happens when you have supply chain disruptions, whether or not that's happening on purpose or what have you, this is going to push the prices up. Also, the reliance on this one individual company, that's never a good thing. So further down in this article here, I'm not going to be able to find it, but looking through here, it actually suggests that the US government is trying to invest and they're going to do their own semiconductors and so on. To do that, to even be remotely challenging to a company like this, TSMC, I think it's the 11th biggest company in the world by market cap, to even be remotely close, you have to invest decades and not just 10 billion, 20 billion, 50 billion, whatever the number was, it was in the tens of billions, I think. That, this is not something that could turn around overnight. I think it's a good thing, absolutely, to invest in actually manufacturing in your own country, or at least somewhere that you have full control over. And the way that they're doing it, I don't think this is I think they're late to the party. That's all I'm saying. Over the past few years, TSMC has increased its R&D spending and saw its market cap become the biggest in the semiconductors. So they're comparing that, and I think this is really key to pay attention to where there's reliance, where there's risks and fragility, you're going to have problems, and that, of course, could make prices of things skyrocket. Money GPS Insights time number 1, 100% of the time, if the Federal Reserve increases interest rates or tapers their money printing, the market corrects or crashes. End of story. Number 2, if inflation goes up, interest rates will follow. Number 3, the repo pro, the repo crisis professional, Zoltan, who I did a video about not that long ago, has confirmed that we could be entering another 2019 repo crisis right now at this time, and the Federal Reserve is fanning the flames. So keep an eye on it. I will cover it here on this channel. There is more desire right now today for more money printing, more deficit spending, and more debt. In this case here, devoting $60 billion to a new round of grants for restaurants. They want to get this bill put in. It's going to, get them through, a little while. But what I have noted, it is very clear. What I have noted right now at this time is that number one, half of those PPP loans, according to some, have suggested were completely squandered money sent overseas. They can't figure that out. Okay, that information is just not going to come out. You're not going to hear about that. You look at really putting all the money in, and unfortunately, it goes to big businesses. It's not to the small businesses. Big businesses overwhelmingly got that money. That's not a good thing. This is an article just talking about the debt cliff. how many times do I have to hear about this? They even say in the article, it's kind of like making fun of it in a way, like, hey, let's just get this going. That's the way it is. Okay, now this is what Real Investment Advice had to say. Definitely look through this, okay? There have been 0 times in history when the Fed started a rate hiking campaign that did not lead to a negative outcome. We suggest this time won't be any different. Now, as they say here, does that mean we're going to go sell off everything? Does that mean we're going to just run for the hills? No. Such does not mean that you should be complacent. However, you should also not be overly defensive at this juncture either. Basically saying don't go all to cash, don't, stuff your cash under the mattress and so on. And that's why I really like Real Investment Advice, because they're a very well-balanced group of individuals. As noted last week, we did raise some cash recently. We are still long our primary core positions. The rotation from value to growth continued, suggesting that markets are already sensing a return to a deflationary environment. We are currently carrying a barbelled portfolio holding an inflationary tilt. However, the deflationary holdings continued to hedge our risk last week. So they do have, of course, a large equity portion. They cover it here on the page. If you have the time, check out the link in the description so you can see that for yourself. If you want to know how to be able to get these videos, because I hear from people every single day that say, didn't get your video, even though I have the bell ticked, even though, forget about all of that. And you got to wake up. You got to make the decision right now. Are you going to get this information, or are you going to basically go to the mainstream media? You got to make that choice right now. I offer the insiders for free to you so that I can make sure to get to you. I'm tired of their system. I'm tired of hearing from the people that try to get my information and they say, look, you're not popping up. Yeah, I don't get you. I don't get your notifications. So forget about all that stuff. Join into the insiders. Join on the insiders. It's free. TheMoneyGPS.com. If you found the video informative, hit the thumbs up button. That's all you got to do. Put a comment if you can as well. Thumbs up are really appreciated. Thank you very much. And if you haven't seen this interview I did with Michael Gayed, it's amazing. He gets into so much information about risk on, risk off, the lumber to gold ratio, and so much more. Click it and I'll see you there.